Welcome to the deep dive. If you're walking in fixed income right now, well, you definitely feel the exceptional volatility and uncertainty shaping things for 2025. It's quite a landscape.
It really is. We're seeing this mix of, moderate growth globally, but persistent inflation issues and huge policy uncertainty. And all of that is really amplified by geopolitical tensions. It's not your standard cycle.
Definitely not. You shared some insights on this environment and a specific company, BondIT. So today, our mission is to unpack the drivers of this turmoil, talk about BondIT and their AI platform, Scorable, and really explore how it can help professional investors like you, asset managers, insurance companies navigate this.
Yeah, the context for 2025 is, uniquely challenging. We're in what some people are calling a G0 world fragmented global leadership. Think about the U.S.-China dynamic, Russia, the Middle East conflicts. It all feeds into unpredictable policy, especially trade tariffs.
And those tariffs, they're not just noise, are they? Some analysis suggests they could knock, almost 0.8% off U.S. GDP growth next year, hitting supply chains, costs.
Exactly. And you layer on top of that these mixed global GDP forecasts. IMF's a bit higher at 3.3%, World Bank down at 2.7%, plus the whole higher for longer interest rate reality.
Right.
And let's not forget government debt levels. Moody's even downgraded the U.S. rating recently. It all just adds up to significant uncertainty.
And that uncertainty, it stalls investment, right? Creates more market volatility. Bonds are especially sensitive, and everyone kind of adopts a wait-and-see attitude.
Yes, but companies can't wait forever. There's this looming refinancing wall. A huge amount of corporate debt matures between 2025 and 2027, and they'll likely have to refinance at much higher rates.
Oof, yeah.
So that refinancing pressure, plus all the macro and geopolitical stuff, it means the credit health of individual companies is really starting to spread out. Figuring out who's vulnerable, who's resilient, that granular credit risk analysis is absolutely key now.
Which I suppose is where technology comes in.
Precisely. And that brings us to BondIT. They've been around since 2018, focusing on tech for fixed income investing. They work with over 165 institutions globally, helping them get speed and scale.
Okay, and Scorable is their specific tool for this current environment.
Exactly. Scorable is BondIT's AI-powered credit analytics platform. It's designed specifically to help fixed income investors anticipate critical rating changes and manage credit risk proactively.
So let's get into Scorable. You mentioned machine learning and explainable AI, or XAI. How does that differ from, say, traditional quant models? What's the AI really doing here?
Good question. Fundamentally, Scorable uses ML and XAI to predict the probability of rating upgrades and downgrades. It does this for nearly 3,000 corporate issuers globally, looking out 12 months.
Okay.
The real difference is the scale and diversity of the data it processes daily. We're talking over 250 unique variables.
And that's beyond just the standard financials.
Oh, absolutely. Financials, fundamentals, yes, but also capital market data, think real-time equity prices, CDS spreads, which are very sensitive market indicators of risk perception, plus external ratings, country factors, industry factors.
Oh, okay.
And it uses things like stacked model architecture, gradient boosting, basically finding complex, maybe non-obvious patterns in all that data that simpler models might miss.
And that explainable AI piece, the XAI, that must be critical for professionals, right? You need to justify decisions.
Oh, vital. Absolutely vital. XAI doesn't just spit out a score, it shows you the why. You can see the impact of each specific variable on that risk prediction. That transparency is non-negotiable today, especially with regulations like CRA Third demanding clear, data-backed reasons for investment choices.
And the performance seems to back it up. The data showed Scorable anticipated, over 90% of downgrades, compared to maybe 79% from traditional rating agency outlooks.
That's right, 90.2% versus 79%. That difference, that 11% gap, represents potentially missed early warnings. And these signals have teeth. Scorable's downgrade signals have historically correlated with CDS spreads widening by about 35% on average. The market reaction follows.
So let's connect this directly to the asset managers, the insurance companies facing 2025. How does Scorable practically help them day to day?
Well, in this kind of uncertain market, getting those early rating transition signals, as Scorable calls them, is huge. It allows for much more timely portfolio adjustments. We heard from Ampega Asset Management, for example, that these signals help their managers make recommendations and act faster, potentially ahead of the market shifts.
So it's about cutting through the noise, getting actionable intelligence faster.
Exactly that. It transforms a massive amount of data into clear, actionable insights. You make faster, more informed decisions. You might spot risks or maybe opportunities before they become obvious.
And for insurers, there's an efficiency angle, too.
Yes, definitely. It helps streamline what can be very complex. Manual credit analysis reduces effort, potential errors. And crucially, that XAI provides the clear documentation trail needed for compliance. Features like the daily alerts engine or the smart lists, which combine transition risk with relative value, directly flag potential trade ideas.
Okay, so wrapping up. In this volatile 2025 landscape, technology like Scorable offers tools for deeper analysis, earlier risk spotting, and crucially, transparent insights.
Right. It's about using advanced analytics to really get an edge, because relying only on the traditional ways might not be enough anymore.
It leaves you with a thought, doesn't it? With all these macro and geopolitical forces causing credit quality to diverge so much across sectors, even within sectors, how will you, as a professional investor, leverage advanced analytics to stay ahead when anticipating change is really the name of the game?